So welcome to today's lecture. Last week we stopped with currency risks. We talked about the market price risks, and you might remember that market price risks entail both stock and equity price risks, risks that arise from changes in bond prices, but also, and more generally, currency risks, foreign exchange risks. Because for a foreign currency, the FX rate is the market price. This is a very particular risk, and not every company will face foreign exchange risk. You only face FX risk as soon as you enter contracts that are denominated in a foreign currency. So for example, if you're a car manufacturer, you produce cars and you want to ship them to the United States, for example, you will face currency risk because you're producing, for example, in Europe, you have costs in euros, but you have revenues that come into your company in US dollars. So if the currency rate changes, you will probably lose, or you will lose some money, or you might also make a small profit. But the profits and the revenues are more volatile due to foreign currency risk. There are simple things you can do to avoid currency risk. And actually, car manufacturers do this all the time. What can you do? You can shift your production to the country in which you want to sell. This, and also for some additional reasons, taxation, political reasons, most car manufacturers also have production plants in the United States. BMW, Daimler, Toyota, they all have car plants in the United States. Why? Because they want to hedge against foreign currency risks, but they also want to avoid taxes. I mean, in the United States, especially nowadays with Trump, it's quite clear that you would also face tariffs and higher taxation. So because of these differences in taxation and in tariffs, these are additional reasons why you want to shift your production to the country in which you also want to sell your products. But currency risk is one important reason for this. Again, this might work in your favor and also to your loss, but in the end, you don't want this volatility in your revenues. You want to hedge against this volatility because you are not a trading corporation in many cases. You're, for example, a car manufacturer, you're an industrial company that does not want to engage in foreign currency trading, and you want to limit this volatility. So this is currency risk. In many cases, or in almost all cases, foreign currency risks appear together with an additional risk. So if you trade, for example, in commodities, commodity risk and currency risk will appear at the same time. You have the risk that the price of the commodity changes, and additionally, also the currency rate might change. If you trade in foreign currency denominated bonds or stocks, same thing, but especially with commodities, this is the case. So many times the risk manager will hedge against the currency risk, and he or she will face some of the commodity price risk because they are usually interested in taking some of this risk. A simple strategy then might be to shift and move production. And if you are not willing to shift production, for example, because it's high maintenance, it is too costly, what can you do? Currency risks are one type of risk that can be easily hedged with financial derivatives. You can buy financial derivatives that have a foreign currency as the underlying. So you'll buy an FX future, an FX option, and you can hedge against this type of risk. And this is usually quite cheap because the underlyings are quite simple. There are not too many main currencies around, and financial derivatives are readily available. And then you can simply buy an option, you can buy a future or a forward contract, and you can hedge against this. We will later on see how this works. At this point here, it suffices to say that you simply take the opposite position in the foreign currency to limit the risk that stems from this exposure to the currency rate and to the exchange rate. Now here on this slide, you can see the price for Brent crude oil This is the spot price in US dollars and Japanese yen. And both are normalized at the start to 0. And you can see the evolution of the time evolution of this price for the same currency, for the same commodity, denominated in two different currencies. And in many times, for example, here and here, you can see there aren't too many and too large differences between the Brent oil price in yen and the Brent oil price in dollars. But actually, there are also some phases here where the difference was actually quite large. And what times are these? If you look at this, it's actually 2009 until 2000, more or less 2013. This is the time and the period of time in which central bank policy differed. The US was hit hard during the financial crisis. You can see the extreme downturn here of the oil price as a reaction to the general economic downturn after the financial crisis. And during the times of crisis, there wasn't too big a difference between the Japanese yen and the US dollars and the US dollar. But after that, central bank policy differed a lot. And you can see that this was reflected in currency rates. It actually stops here. It might be interesting to see how this went on after 2014, because as you might know, the Japanese government nowadays follows a strategy called Abenomics, a policy of extreme loose monetary policy, and they are literally printing money to put a stimulus to the general economy. And it's, I think, the most extreme central bank approach any industrialized country has taken over the last couple of years. And I would assume that the difference between the two prices is now again quite extreme due to the difference in the currency rates. Okay. Now, has the introduction of the euro led to a reduction of currency risks? Question for discussion. Do you think that this has led to a reduction of currency risks? It depends from what point of view you are looking at it. Yeah.
In the European Union, maybe yes, but internationally, I don't think so.
Internationally, yes, of course. First of all, the introduction of the euro, of course, has eliminated many exchange rates. And in the European Union, one would assume that these exchange rates no longer exist. But still, in many cases, you can observe that prices are somehow connected to other foreign currencies. The US dollar, the Japanese yen, for example, are still major currencies, and especially the dollar. Many things are connected to the dollar. If you look at commodity markets, most of the financial derivatives, most of the main indices, for example, Brent crude oil, all these indices, they are denominated and they are traded in dollars. So even if you only trade in the Eurozone, for example, electricity, other commodities, there is almost always a small connection to a large major index, and this one is probably traded in dollar, in the US dollar. So you will still, even if you are only trading and doing business in the Eurozone, you will still have some currency risk left. And of course, it has limited and reduced the currency risks from European countries to each other, but I would also assume that in some part these currency risks are still reflected in prices. Because what do currency risks reflect? They also reflect the stability and the power of the respective economy. And I would assume that if you go, for example, to France, if you go to Spain, or if you go to Poland, prices from one country to another will still differ a lot. And before the introduction of the euro, this was simply reflected in the exchange rate. Nowadays, it's somewhere hidden in the prices. Okay. Now, currency risks are quite simple. We also have, of course, securities risks, the risk that market prices for securities can change. This is usually what we think of if we talk about market price risk. A bank buys a security, it buys bonds and stocks. The prices for these bonds and stocks can change, and if these prices change, the bank will earn or lose money. That means the risk can arise from unfavorable changes in the prices of these securities. Usually all securities are traded on exchanges. That is, we have market prices. Sometimes we also have structured financial products. We have certificates on stock indexes. They are also subject to this risk. Again, we might have falling prices, or we can also have higher volatility in indexes and market prices. And this usually makes it difficult to predict the time evolution of these prices. If we were able to predict the price evolution, we would have won the lottery. If I were able to predict today's and tomorrow's stock price development, I would probably not be standing here. So as a consequence, you will try to model the statistical behavior of these market price time series. You will try to accurately estimate the present prices you can observe right now, and you will try to forecast the development, the time evolution of prices a couple of days into the future, or at least forecast the volatility. And in many cases, you will not be able to do this for one particular stock, but you will at least be able to forecast the general development of the market on average over the next couple of days. And you will try to use highly elaborate and sophisticated statistical models, and you will try to get the models that fit best the data. But still, I always stress this. It is nice that we have sophisticated statistical models, but in the end, it all boils down to finding a distribution, a statistical distribution that fits the data best and that ideally is able to forecast tomorrow's and future stock returns if we are looking at stocks. But if these models were perfect, we would be able to forecast tomorrow's lottery numbers. And again, these models can do a lot, and they are quite sophisticated, but you will never be able to forecast tomorrow's stock returns. So every time you hear people talk about, our models for market price risk failed and these models were not accurate enough, you still have to think about what these models are meant for. They are meant for accurately modeling the data at hand, and ideally the statistical distribution and the distribution law that governs this time series will be forecasted into the future, and this distribution will be stable. But as soon as the distributional law changes, you will no longer be able to forecast tomorrow's stock returns just by using today's data. And some practitioners haven't understood this, one has to admit. Some bankers still think that these models should be able to forecast all losses that might arise. Now, for some securities, it is quite difficult to draw a clear distinction between the market price risk and interest rate risk. We will still talk about interest rate risk, but why is it difficult? Think of, for example, a coupon bond or a zero bond. If you were to buy a government bond of the German government, you would be buying a bond that offers, for example, you pay 100 and you get 5, 5, 5, and 105 as cash flows. This government bond is assumed to be risk-free because the German government is hopefully never going to default on its bond. on its bonds. So it has a cash flow of 555, 105. No default risk, but then how should the price look like? To estimate the price, the arbitrage-free price, you would simply take this 5 payment and you would discount it. 1 plus r for a period of t equal to 1. So you would continue to do so, r squared, and this time we need the interest rate for a 2-period investment and so on, and we would calculate the net present value of this cash flow stream. But this also shows you that in the end you will get a price P, a market price, and what really is the change in market price. The change in market price is a change that is due to changes in interest rates. The cash payments, the cash flows will not change. Those are with a bond, these are fixed. The only thing that can change are the risk-specific and the appropriate interest rates used to calculate the net present value. So what type of risk is this? Yes, it's market price risk, market risk, because market prices might change. But these changes in market risk are actually due to changes in interest rates. And this is why one has to be careful when distinguishing interest rate risks and market price risk. If, for example, you have a security that is risk-free, the changes in market risk are solely due to changes in interest rates. So there is no distinction here between market risk and interest rate risk. No? Similarly, if you buy a bond and it is not a government bond, or a bond that is totally free of default risk, if it's a regular corporate bond, this corporate bond will include default risk. So again, if you see changes in market prices, yes, this is market risk, but also these changes in the market prices of corporate bonds, these are due to changes in interest rates, but they might also be due to changes in the default rates. Then again, it's credit risk management. It's credit risk and not market risk. You know? So this is somehow philosophical. Is it market risk? Is it credit risk? Is it market risk? Is it interest rate risk? Usually with corporate bonds, this is credit risk management, because it's all due to changes in credit ratings. And with government bonds, this is interest rate management, and interest rate risk management. Okay. So be careful. These market price risks should never be understood as or looked at in isolation. You should always look at all the different risk factors in play here. So for a corporate bond, you have interest rate risk, you have currency risk, you might have currency risk, you have credit risk, and they all play together and form these changes in market prices. Especially this is true with commodities. If you do a trade on commodities, even a derivative trade, it might be that you have counterparty risk. If it's an OTC contract, you have counterparty risk, you have currency risk, you have credit risk. So all these risk types come into play together. Okay. Next, let's turn to interest rate risks. Interest rate risk is defined as the risk of changes in interest rates that comprises losses in assets resulting from changes in the market interest rates that are relevant to an asset position, which simply means you have a position in a bond, in a stock, any other security, any other financial position, and the prices for this asset change when interest rates change, usually market interest rates. And if this is the case, this is interest rate risk. The prerequisite for this is, of course, that the asset value depends on an interest rate. If you, for example, have a security, if you have a stock investment, usually the prices are not very sensitive to changes in market interest rates. So this is the counterexample. For a bond, it's quite clear with fixed interest with fixed income products, these prices will usually depend on market interest rates. By the way, if you look at bonds or coupon bonds, zero coupon bonds, zero bonds, they are usually referred to as fixed income products. This is fixed income. Why? Because the cash flows are fixed. Yeah? For a stock investment, you don't know what dividend the company will pay out next year. With a bond or a zero bond, you know that the payments are fixed and the price will only depend on default risk and interest rates. But if you are looking at bonds, this is what we refer to as fixed income products. And this is the category of securities. Okay. Interest-bearing securities, loans, and securities whose value is determined by net present value calculation. All these are examples for securities whose prices depend on market interest rates. It's interesting to see that actually we don't have to look just at bonds, but loans granted by banks are also exposed to interest rate risk. Why? Yeah?
There is non-adjustable loans that
Yeah? Actually, yeah. This is interesting. One would think that loans with a variable payment, with a variable interest rate, are the ones most exposed to interest rate risk. Yes and no. Yes, if the market interest rates change, the payments on the loans will also change. But the problem is, think again of the bond. The bond has fixed payments, and the bond is nothing else than a securitized loan to the buyer, by the buyer of the bond, with fixed payments. But what is the fair price of the bond? The fair price is actually the fixed payments discounted by the market interest rate. And if market interest rates change and the payments on the loan are fixed, or the payments on the bond, actually you are discounting with a higher or lower interest rate, and that will be reflected in the arbitrage-free price of the loan of the bond. So if the bank wants to value its loans, it's actually the loans with a fixed payment that are highly sensitive to changes in market risk. For the price, for the fair value, it also depends what the bank is willing to do with this bond. If it wants to value the loan, if it wants to sell the loan, for example, to another bank, or if it wants to securitize the loan, it will look at the net present value. And the net present value will be sensitive or highly sensitive if you have fixed payments, because then you will discount the fixed payments with a higher or lower interest rate. Yeah.
But then for the person paying the loan, it differs, right?
Yeah, of course. Yeah.
Has to be seen separately from.
Yeah. And also if the bank holds the loan until maturity, it will also look different, because then, of course, the prices will change, but also future payments might be higher and lower, and then you are hedged against interest rate. So the interesting thing here is that actually banks have very high exposure to interest rate risk. It's not just credit risk. And think of it in a different way. For example, if you are a bank and you give out a loan, and this is what happens right now. With the zero interest policy of central banks right now, banks are giving out very cheap loans, comparatively. They're giving out loans, say, for example, at 1.5, 2.0%. And if you give out a loan with a 2% interest rate on it, and now you have fixed this interest rate payment for the next 10 years. I've actually done the same. I'm paying 1.5% on my mortgage loan. 1.5%. That's ridiculous. Now imagine interest rates will increase later on. That would mean that in, let's say, 5 years, the bank would be able to give out a loan at 3 or 4%. So the opportunity costs are quite different. And the bank could now grant the loan for, say, 3 or 4%. So if market interest rates change, of course, the value of a bond or a loan given out at a higher or lower interest rate will also change. And actually, it's the same with bonds. If you look at the prices for bonds, for government bonds by the German state given out at the start of the 90s, you can see that they have very high coupon bonds, very high coupon rates. They pay out 6.5%, but this is also reflected in the market prices, and you have to pay a lot for these high interest rate and high coupon bonds. So you have opportunity costs. And remember, banks also have a high exposure to interest rate risk. So a couple of examples here. For example, a bank could have issued a credit at a higher interest rate. In this case, the resale value of the credit of the loan would change unfavorably. On the other hand, if the bank does not sell or sign the loan until maturity, the change in market interest rate will not lead to an immediate loss. Will simply earn the higher interest rate payments. In contrast, market interest rate changes in interest-bearing securities directly lead to price losses. And this is quite clear for fixed interest products, because in the end, the price, the arbitrage-free price of the bond is equal to the net present value. And then you will use a different interest rate for discounting the fixed payments on the bond. Now, this example, if the interest payments are variable, for example, when interest payments are linked to an index or interbank offered rate, like the 3-month Euribor, fluctuating market interest rates usually result in lower price losses because you will earn a higher interest rate payment, but you will also use a different adjusted interest rate for discounting. So you will earn €1 in a higher interest rate payment, but you will also lose €1 because discounting is higher and the discount factor is higher. So changes in the expected variable interest payments, they are offset or they are compensated by the resulting changes in discount factors. Actually, this is why it's quite simple to estimate and to calculate the arbitrage-free price, the fair price of a so-called floater. Do you know what a floater is, or a floating rate note, an FRN? You know what a coupon bond is. A coupon bond is a bond, so a securitized loan that, for example, on a notional value of 100 pays out 555 and 105. What is a floater? A floating rate note. A floater is also a type of bond that you have to pay P, a price P, but you're getting a variable payment of interest rates. You will get back the notional value of 100, and finally, again, a variable interest rate of V. And the interesting thing now is that this variable interest rate is fixed at the start of the period. So, for example, if we buy it, we are now fixing the variable payment at the end of this period. And here, at this point, we are fixing this one. We are looking at, for example, the LIBOR or the Euribor as an interbank offered rate. And if we see that the 3-month Euribor is, for example, 2%, we are fixing it here, and it is paid out here. And one would think that this floater is very hard and very difficult to value. Why? Because we don't know what the Euribor will look like in 3 years, in 4 years, in 5 years. Actually, it is simple. It is very simple. You only need the very first variable payment, because all the other changes in the variable interest rate, they offset each other, and the change, for example, in the payment is offset by the change in the discount factor, and you only need to look at this very first variable payment, and actually this is the one that is fixed at t equal to 0, and this one is already known. So you can simply value a floater by all the market data available today, and the reason behind this is that all the payments are hedged against interest rate changes. Yeah? So you have changes in the payments, but you also have changes in the discount factor, and they are offsetting each other. So this is the same here. And these are actually the fixed income, or they are not fixed income, but these are the interest-bearing products that are more or less immune to changes in interest rate risk. Okay. Small example. Let there be two risk-free zero coupon bonds with a nominal and notional amount of 100 and a current risk-free interest rate on the market of 10%. Now, we have two bonds, two zero bonds actually. The cash flow of the first bond is 100 in t equal to 1, and you simply take 10%, you calculate the discount factor, you estimate or you calculate the net present value, and the net present value is 90.90, and this one, this is the fair price of bond 1. We have a zero bond with maturity in 3 years. You take the discount factor, and you can calculate the price, and the price of the second bond is 75 euros, for example. Now, if we increase the interest rate to 12%, you can see that you use different discount factors, and you can see that both prices will decrease. Yeah? Quite simple. You have to use discount factors that now incorporate higher interest rates. So you are discounting with a higher interest rate, and prices will decrease. And this is also very simple. If the fixed payments don't change, and you suddenly can earn 12 instead of 10% on the market, on the spot market, why invest in this coupon bond or in the zero bond? Now you can simply put your money on the capital market and earn a higher interest rate now on the market. Okay, so this is the first example. The second example, let there be 4 risk-free coupon bonds with a nominal amount, a notional value of 100, a coupon of 2%, and a current risk-free market interest rate of 1.5%. Now, again, you can see you have 102, 2, 102, 2, 2, 102, and so on. Now, to estimate the price, to calculate the price, ideally, we would use maturity-specific interest rates from the yield curve. That is, you would have one interest rate for a maturity of 1 period, an interest rate for a maturity of 2 periods, and so on. So you would not use just one interest rate, but you would use R1, R2, R3, and R4, and these would probably differ. Now, for simplification, we are using a flat yield curve that is a constant interest rate of 1.5%. Now, everything else equal, the price of a coupon bond decreases as the maturity of the notional approaches. So you can see here, actually, if you decrease it, you will get closer to 100, which is quite clear. Okay. One interesting fact, and something that is usually a little bit obscure in newspapers and TV news. This is an extract from Thomson Reuters financial data stream. It's in German, but you can figure out the most important parts here. You have, well, what is it? Does anyone recognize this? What is it? It's a chart of probably a government bond. What is it? Yeah?
Greece?
Yeah. It's a Greek government bond. You can see the official name of Greece. It's the Hellenic Republic. It's a government bond by the Hellenic Republic issued in 1995 with a 5.8% coupon. Also, quite clear, back then interest rates were much higher. And also some countries had to pay a lot on their bonds. If you want to raise the capital, and even as government, and if no one's willing to buy your bonds, you have to increase the price. You have to pay a higher interest rate. So the Hellenic Republic back then paid 5.8% on its coupon, and you can see that this bond matured in July 2015. actually you can see I took this snapshot in March 2015, and this one expired 4 months later. This was, well, not at the height, but still in the aftermath of the hot phase of the euro crisis. And what you can see here is, you can see the price of this bond here in the blue line. This is the quote of the, on the right hand scale here, the price and the quote of the bond. Now remember, the government bond pays out a fixed interest payment, a fixed coupon of 5.8% on 100 euros. And this will not change. This bond was issued in 1995, and it expired 20 years later, and the payments are fixed. So what happens? If you think that an investment in Greek government bonds should give you a return of 5.8%, you would have to buy this bond at price 100. But if you think the risk is actually much higher, what would happen? What you can see with the blue line on the right lower part of this plot, prices decreased a lot. Starting in, I think it was over the last year, in 2014, you could see that the price of this bond was at 103. So you had to pay 103 euros to get an annual coupon payment of 5.8 and 105.8 at the end at maturity. So still looks like a bargain, right? You only have to pay 103, you get a payment of 5.8, and I think, well, actually, this bond only paid out one single payment, right? 105.8. But still, might have been a bargain in August 2014. But then, prices fell to almost 85. So you only had to pay 85 euros to get a payment of 105.8 at the end, at maturity. And you can see that actually the prices of this bond decreased a lot given the euro crisis. And this is probably not due to changes in interest rates. Yeah? Even with the government bond, this is all due to credit risk. You know? And this is something that is usually also quite misleading in news. Because at that time, you could often hear that the return on Greek government bonds increased. Returns on Greek government bonds are now at 15, at 18%. What does that actually mean? First of all, it means that prices fell. It is misleading because sometimes you usually think that a return that is high is something good. If you hear, for example, Apple reports a return on its stock investment of 20%, this means that Apple is paying out a dividend that is so high that the return is quite high. So that for stocks, this is super. But for a government bond, what does it mean, or on a corporate bond? It simply means that prices are so low that if you now buy this bond, you would buy the bond for 85 and you would get a payment of 105, so the return is astronomical. But this also means that no one is really expecting that you will be able to earn the 105.8 at the end. Everyone is expecting the bonds to default before, so the high return simply reflects the high risk we are taking, the high default risk. And the return, the internal rate of return on this bond is simply high because prices are so low. So if you heard prices for returns on Greek government bonds are so high nowadays, this simply means that those are comparable to penny stocks. No one is buying them and everyone is trying to sell them off. Actually, as you know, the Greek government did not default. So if you had invested in 2015 in Greek government bonds, you would have been able to earn a very high return. But this would have been a gamble. Okay. Here, again, a different example. You can see the comparison between the different Greek government bond, this is the blue line, and a German government bond. This is a German government bond issued in '86 with a 6% coupon and a maturity of 30 years, so a very long-term bond. And you can see the price for the German government bond started at 120 and it slowly decreased to 100. One would assume that the German government bond virtually has no default risk, and if the notional value is 106 at the end, we would assume that the price slowly decreases and converges to 100 at the end. After all, paying off 106. And here we can see for the German government bond, this is true, and we would assume that is due to the fact that there is only interest rate risk, there is no default risk. Here you can see the extreme volatility in the Greek government bonds. And the question now is, what part of this volatility is due to interest rate risk, default risk? Now for the Greek government bond, this is extremely difficult to say. This might be interest rate risk, for example, those small, even with the German government bond, you can see that there is some volatility here. And this volatility is probably due to interest rate risk. And here at the end, you can see that at this point, I would assume, at this point, during the height of the euro crisis, default risk was absolutely, for everyone, at zero, for Germany at least. Everyone knew that, okay, Greece might bankrupt and might default on its bonds, but everyone knew that Germany and France would be the last stand of the European Central Bank that would be defended before the European Union would have imploded. I mean, if Germany had defaulted on its bonds, that would have been a catastrophe, I would even assume larger than the financial crisis. So at that point, everyone knew that Greece might go bankrupt, but Germany never ever. So at this point, you can see that the volatility actually is close to zero. It simply just smoothly converges to 106, to the price at the end. But with Greece, it's probably most credit risk, but it also is some interest rate risk. So, yeah, how can you explain the different price developments and price movements? That's quite clear. And also, there is one additional effect here in play. What might it be? It's not interest rate risk, that it's not default risk, yeah?
I would say monetary policy, but that's
Yeah, that's also connected to interest rate risk. One simple effect that is especially in place starting here. I would assume that at this point, everyone tried to buy German bonds. We had zero interest rate policy by central banks, and as you probably know, many pension funds, insurance companies, and asset managers usually look at government bonds to include in their portfolios as risk-free or virtually risk-free investments. And back in 2005, 2010, even Greek and Spanish, Italian government bonds were considered to be virtually risk-free. And pension funds and asset managers, they bought government bonds from all Eurozone countries. But at that point, especially due to regulatory requirements, all the pension funds, insurance companies, asset managers, they wanted to get out of these investments and they wanted to buy other government bonds that were still considered to be risk-free. Ergo, they bought German government bonds. So this is the additional effect here. Yeah? Everyone wanted to buy German government bonds. And you can see that the demand increased a lot here. And this is also one reason why nowadays Germany has virtually no interest rate to pay on its government bonds, because the German government just knows that they will be able to sell their government bonds even at a interest rate with a coupon that is close to zero. I can tell you an anecdote later on this period, I think, that is quite interesting. Credit risk. We haven't talked about credit risk. That is, of course, especially for banks, one major risk that banks are exposed to. Now, it's interesting to, first of all, see where credit risk comes from. If a company holds receivables from private persons or other companies, the company is exposed to the possibility that its claims are not or not partially settled. And this risk is what we refer to as credit risk. It's quite general. If you have a claim against another company or another person, you have credit risk. And this is important to note because this means that even industrial firms are exposed to credit risk. For example, if you look at any company here on High Street, if they are selling products and they are not collecting their receivables at the same time, they are not cashing in on their sale, this means that they have credit risk. If you go, for example, to MediaMarkt and you buy a TV and you buy it on credit, you're not paying at the same time, but you are paying, even with a zero interest rate, the company faces credit risk. And this is why every industrial company, even if it is not in financial services, if it sells products on credit, this means that you have credit risk. I probably have told you this example of energy companies, especially energy companies have large credit risk exposure simply due to the fact they are selling electricity. You only have to pay your energy bill at the end of the month, and even if you don't pay up, the energy company, at least in Germany, will wait 3 months until they stop delivering electricity. So they have huge credit risk exposure. It's different from bank loans because the risk exposure is standardized and it's small for each customer, but in some it's quite huge. So energy companies, industrial companies, they all face credit risk, or sometimes it's referred to counterparty default risk, and we'll talk about this in more detail. For banks, it's quite clear. Banks are in the business of lending, they give out loans, and they face credit risk. Banks will never try to eliminate credit risk completely, because this is the risk they want to take. They want to take credit risk, and they want to diversify their credit risk, and to manage credit risk, and this is one function they can do. Banks are earning money by being better at managing credit risk than each and every one of us. For example, you have to imagine what function do banks have? You might be in possession of, say, 10,000 euros, and you want to invest 10,000 euros. You could start asking everyone here in this room, does anyone want a loan? Then you have to check the credit rating. You have to check whether he or she is able to repay the loan. You have to calculate the proper interest rate, the risk-adjusted interest rate. And at that point, you will realize this is too much of a hassle. And you can simply go to a bank, give the 10,000 euros to your bank, and the bank will specialize on evaluating credit applications, and this is one function of banks. They are good at managing credit risk, and they are better at managing credit risk than individual investors. Again, this is also true to industrial firms. The only difference is this, they don't give out loans, they sell products, but in the end, the result is the same. They have receivables and they have to wait for their money, and usually they will not wait so long to get their repayment, but they will only have to wait, say, 1 or 2 or 3 months. So we have credit risk in the retail sector, in the energy sector, and it still very much depends on the nature of the business you're doing. For some businesses, for example, you will not have any credit risk. For example, the perfume store across the street, they will not have credit risk. they will pose a credit risk to their suppliers. They will probably buy wholesale products to put in their stores. They will buy, let's say, a huge amount of perfume, and they will tell their suppliers, we are taking the perfume and we will pay at the end of each quarter. So their suppliers will face a credit risk exposure if the perfume store chain defaults. But usually the customers have to pay at the same time. They have to pay immediately. Okay. Now it is important to see the following difference and to differentiate between credit sense in a narrow sense and credit risk in a broader sense. In German it's Kreditrisiken im weiteren und Kreditrisiken im engeren Sinne. The difference is the following. The first situation is that you have credit risk exposure to a creditor that can default, and if he or she defaults, your money is lost as a whole. You have a 100% loss on your money. So you can distinguish between a loan that is in default and a loan that is not in default. This is credit risk in a narrow sense. Yes, no. Default, yes, no, 1 or 0. So it's a discrete situation. Yes or no. Credit risk in a broader sense means that it's actually a fuzzy decision. It's a fuzzy universe where you have absolutely no default risk on the one hand and default on the other, but also some situations in between. And this is where credit ratings come into play. So you will have to look at the probability of default. If you have no probability of default, you are risk-free, and you, in the words and in the sense of a rating, you will have a AAA rating. But then you can also have a double A, you might have a triple B, a double B, triple C rating. So you will have a universe of different default probabilities, and you will distinguish between not just default, no default, but you will distinguish between absolutely safe, well, almost safe, not so safe, close to default, and now he or she is in default. This is what usually you will look at in credit risk management. You will not look at this discrete decision between yes or no default, but you will look at credit ratings, at credit default probabilities. And this is credit risk in a broader sense. Now, up until the financial crisis, no one really cared about counterparty risk. Counterparty risk is also closely related and a part of credit risk, but this is more, it's not so straightforward as the default risk on a loan. What does counterparty risk mean? It usually is part of any trade, of any security and any contract that is done OTC, over the counter. What does OTC mean? Can you describe what OTC means? If you buy a stock on an exchange, you will buy a stock of, say, Apple Corporation. You don't know from whom you are buying the stock. You simply know that the stock exchange tells you a price, and the stock exchange guarantees all payments, and it guarantees that you will be delivered one stock of Apple Corporation. So the stock exchange is functioning as an intermediary, and it guarantees all payments. And if, for example, the seller of the stock defaults and suddenly says, oh, sorry, I don't have the stock, this simply means that the stock exchange has to punish the seller, but it has to step in and it has to give one stock of Apple Corporation to the buyer, because this is the function of the stock exchange. It guarantees payments, it guarantees delivery, and it regulates market entry. And if it realizes that one market participant is close to default, it will expel this particular market participant. So, what is OTC then? What is an OTC trade? It's the opposite, yeah?
It's without an exchange in the
Yeah, it's a trade with no exchange in the middle, but then how does it work?
If it were possible, you go to Apple and I'd like to buy one of your stocks directly from you as a company.
Yeah, not quite. You wouldn't go to Apple itself, but you would, for example, go to a room like this, and you would yell, I want to buy one stock of Apple Corp. And then someone else would say, I'm willing to sell one stock, and then you would have to figure out the details of the contract yourself. The contract would not be standardized, and there would be no exchange involved. You would have to draw up a contract yourself, and the advantage, of course, is that you can include any type of ridiculous detail in this contract. You can suddenly do a derivative contract and say, I will buy the Apple stock in 1 month only if Germany scores the first goal in the soccer World Cup. Yeah? Then it would be a conditional. It would be conditional on a certain trigger event, but it would be possible to do this. In OTC trading, you don't need standardized contracts. You can do any type of contract as long as it's legal, of course. And what is the problem now? First of all, you need to find a suitable counterparty. You need to find someone willing to enter this contract. That is not the difficult part. You will always have OTC exchanges that work like a news group or a trading place like this. The difference between a regular stock exchange and an OTC exchange is that in a stock exchange, in regulated markets, the payments and market entry are regulated and they are guaranteed. In an OTC trading place, this is more or less just a meeting place for large institutional investors. And if you have, they're usually IT based, and if two partners find themselves and they see that they agree on a contract, the exchange will only guarantee and only make, how should I put it, they will only make it easier for the market participants to find a suitable counterparty. They will not guarantee payments, and they will not offer standardized contracts. And then the two parties will enter this OTC trade. And now the problem is, if, for example, we enter this very simple OTC trade. I want to buy one stock of Apple, you want to sell. And we do it in an OTC trade, and we agree on a payment. And now assume I have already paid out $150 for the stock, and you suddenly say, I default. Yeah, my company is bankrupt. I've paid out 150 dollars, and my money's lost. Yeah, the company is in default. The counterparty has defaulted, and the OTC trade is, of course, immediately affected by this. And counterparty risk is the risk that in an OTC trade, in an OTC contract, the counterparty defaults. And in this case, in the worst case, your payment is completely lost. In the best case scenario, you haven't paid a dime, but the intended purpose of this OTC trade is lost. And this has become rather infamous during the financial crisis. Do you know which OTC trades were heavily affected by counterparty risk during the financial crisis? Yeah? Yeah, credit default swaps. And it went like this. A CDS, a credit default swaps, works like this. You have a reference unit or reference entity. Let's make it a small example. You are now Apple Corporation. Apple Inc., I don't know. Say you're Apple. And I am an institutional investor who wants to ensure myself against the default of Apple. Now, how should I do this? I want to buy insurance against the default of Apple. Now, usually, I can buy insurance, but only in many cases if I have supplied products to Apple. For example, if I have sold a large machine to Apple and I'm still waiting on my money and I'm currently shipping this machine from Europe to the US, then I can buy insurance. This is frequently done in engineering. If you are creating large machines and you're selling these products overseas, you can buy insurance against the default of the buyer. That's no problem. But these insurance contracts can only be bought from insurance companies if you have an underlying contract in which you have sold products. Now, if I have no business relation with Apple, but I still want to buy insurance against the default of Apple, I cannot go to an insurance company. No insurance company will offer this type of insurance. But I can buy a credit default swap. And in a credit default swap, for example, you are an investment bank, and we two get into a room, and I would ask you if you were willing to sell me insurance against the default of Apple. Then I would ask for an insurance of a notional amount of $100 million. And you would tell me, okay, the probability of Apple's default would say, let's say 2%. You would calculate a risk premium, and then you would tell me, okay, we draw up a contract. Over the next 5 years, if Apple defaults, you will pay me $100 million, and I will pay you a premium of, say, $150,000 each year for 5 years. If Apple defaults after 3 years, I will get the $100 million, and then, of course, I don't have to pay the next premium, because then the contract has stopped. And if Apple does not default, I will pay you the premium each year for 5 years, and at the end, nothing happens. So it's just like a regular insurance. Yeah? You have to pay a premium, and you get how is it? You get, what is the word? I'm lacking the word, the English word for a Versicherungsleistung. It's an indemnity payment. Yeah? That's called an indemnity payment in English. And this is a CDS contract. And the most important differences to an insurance contract are, first of all, I, as the buyer of the CDS, I don't need a business relation with the reference entity. You, as the selling company or the selling investor, also don't need any relation to Apple. And for me, this is beneficial how? CDS contracts are a very good way to invest in credit risk. And at first, this sounds strange, to invest in credit risk, to invest in risk. What does it mean? If I expect someone to default, I can buy insurance. But you, as the institutional investor, you are willing to assume the risk, the credit risk of Apple. And you could, first of all, if you're a bank, you could try to ask Apple, do you need a loan? I want to give you a loan, and I want to earn, let's say, 5% interest rate. If Apple tells you, I'm in no need of a loan, I have enough cash, you cannot invest in the credit risk that is posed by Apple. But if you find someone who wants to buy a CDS, you as the institutional investor can invest in credit risk. The counterparty can insure itself against the credit risk exposure, and this is a very good trade for all parties involved. Problem is, during the financial crisis, or before the financial crisis, many investment banks bought insurance and bought credit default swaps with other banks and other entities closely related to banks as reference units. And the problem was that you had many investment banks that had bought CDS And they had all bought it from one company. And that company was AIG. AIG, no one realized that, because this market is OTC, this is an OTC market, and it's not regulated. It used to be not regulated. And at some point during the financial crisis, regulators in the US government realized that actually AIG, the largest insurance company in the world, was actually the largest counterparty by far, with I think $1 or $2 trillion outstanding notional. They were extremely highly invested in the CDS market. And the insurance business wasn't any problem. But because they had such a short position in the CDS market, because they were the seller of credit insurance, during the financial crisis, many companies started to cash in on these CDS contracts, and AIG took many hits from this trading activity. And then, when AIG came close to bankruptcy, suddenly there was the risk that all banks would suddenly lose credit risk insurance, and the US government stepped in and they bailed out AIG. It was the first and I would say only time that in history of financial markets an insurance company had to be bailed out. Because usually insurance companies are not systemically relevant. But at this time, some people, and especially insurance economists, usually joke, AIG ceased to be an insurance company, and they were actually a trading company with associated insurance business. No? They were no longer in the insurance business, but they were in investment banking. And this is counterparty risk. Now, these investment banks, they would not have faced an immediate loss in case AIG had defaulted, but they would have been left standing without any credit risk insurance. And if you are calculating, and if you are doing your business, and you think, oh, nothing can happen to me because I have a CDS contract, and I'm insured against the default of, say, Lehman Brothers, you think, okay, it's okay. And you are hedged against this risk. But at that point, many banks suddenly realize, if AIG defaults, I'm left standing with my trousers pulled down, and if then Lehman Brothers also defaults, I'm in big trouble as well. And this is the problem with counterparty risk. It might result in an immediate financial loss, but it might simply mean that you think you have insurance, but actually you don't. And this is why CDS markets and OTC markets have become more regulated than it used to be the case before the financial crisis, because regulators realized that an intransparent, opaque market that is so big in volume can be detrimental to financial stability. And this is counterparty risk, a big problem during the financial crisis. You also have some additional subtypes of credit risk. Replacement risk from derivatives. If, for example, your counterparty on a derivative defaults, you need to replace and buy an additional derivative. Issuer risk, the default of issuers of tradable debt or equity securities. This is just corporate bond risk and credit risk with corporate bonds. Fulfillment risk, risk that one contractual partner will not perform while the other already has performed its duties stemming from a contract. Country risk, that is also sometimes referred to as sovereign risk. Almost the same as market price risk also. If a country defaults, you will get in trouble if you have bought government bonds. These government bonds will be worthless, and then you face country risk. Okay. And I have talked about this already. One idea to alleviate this problem of counterparty risk, especially in the CDS and credit derivative markets, is to include a so-called central counterparty. It's the idea to shift the general outline of an OTC market into the direction of a regulated stock or exchange-based market. So you now include a central counterparty, and the central counterparty is meant to guarantee all payments. So the OTC market somewhat ceases to be a highly intransparent and highly unregulated market, and it moves a little bit into the direction of a regulated market. And with a central counterparty, this risk of counterparty risk is somewhat removed and eliminated, nowadays at least. Okay. Now, again, we've talked about counterparty risk when it comes to CDS contracts. Now, the central counterparty takes up the task of what is called clearing. And what is clearing? Clearing is the entire process of settling a financial transaction. And in particular, this includes the determination and settlement of mutual claims, liabilities, delivery obligations, as well as the transmission and wiring reconciliation of information relevant for the settlement. As in OTC trading with central counterparties, market participants do not enter into transactions directly, but always indirectly via the central counterparty or via the exchange. And with an exchange, for example, Deutsche Börse or the New York Stock Exchange, the settling and clearing will be done by the exchange itself or by a company that is owned by the exchange. Now, I think with Deutsche Börse, the Frankfurt Stock Exchange, they have a fully owned subsidiary that is responsible for settling and clearing. Now, what does it mean? Imagine you wanted to trade on the stock exchange. If we, for example, agreed on the purchase of one Apple share, this would mean that I would have to tell someone that this is my account. In this account, I have you are selling. I have this amount of money. You would have to tell someone, this is my account, this is where I keep my stocks. Then you would have to transfer the information that one stock is now transferred to a market participant you don't know, because this trade is anonymous. You have to tell the stock exchange, please transfer one stock from Apple to this buyer, this anonymous buyer. I would have to pay money to the stock exchange. The money needs to be wired to your account, and all this information and all these payments have to be exchanged. And this is what we refer to as clearing and settlement. And it's more sophisticated and more complex, like this very simple example. Because, for example, in many cases, we are trading a lot. And for example, if you, as a market participant, were to sell one stock of Apple and you were to buy one stock of BMW, it might mean that in the end of the day, you don't have to pay anything. You're selling for 100 euros, but you're also buying for 100 euros. So you don't need to pay any euro to the exchange. And this is what clearing and settlement actually is. The exchange compares all the payments. They have to make all the payments, they have to net them. So you have netting, you have clearing, and this is done in real time, and this is done in huge volumes. I mean, the volumes of these large exchanges go into the billions, and this is what the stock exchange does. So clearing and settlement. And also, what is the stock exchange also has to calculate margin requirements. Does everyone know what a margin and a margin requirement is? Might be on the, is it? No, it's not on this slide. If, for example, you enter a future contract, if you trade in derivatives, in many cases, you enter a contract, you buy a derivative, but you only have to pay later. And the price you have to pay can still change. So this means that, for example, nowadays, today, you would enter a contract that is worth 100 euros. And you are able to pay 100 euros. But if the price develops adversely, you might have to pay 200 euros. And you might not have 200 euros, you only have 150. So the stock exchange, during the course of this future contract, will require a certain safety payment, a margin payment on an account with the exchange. And if the stock exchange realizes, or it's the exchange, the derivative exchange, if the derivative exchange realizes that your margin payments are all used up and you are suddenly risking the possibility that you are no longer able to pay up at the maturity of your future contract, the exchange will tell you, please pay an additional amount of money into your margin account. And this is what is called a margin call. And at that time, you have to pay, or the exchange will close the position. They will force you to sell your contract, and they will also usually punish you by expelling you from the exchange. Yeah? It's margin call is, I think, also the name of one movie, or at least a documentary on the financial crisis. I think it is called Margin Call. It is usually the time when the margin payments are used up, and market participants are somewhat forced to pay additional money into their margin account. And my prime example, I guess only a few of you know the movie Trading Places with Dan Aykroyd and Eddie Murphy, classic one. It's a movie where two stockbrokers make a bet that they can switch a homeless person into a stockbroker and a stockbroker into a homeless person, played by Dan Aykroyd and Eddie Murphy. And at the end, they try to trick the two old stockbrokers, and they force them into a futures position in frozen orange juice. And those old villains, they realize too late that they have an open position that is worth 250 million euros, so dollars. So they would have to pay $250 million, and suddenly the closing bell rings, and the regulators and officials of the exchange go to them and tell them, okay, margin call, you heard the bell, you have an open position of $250 million, pay up. And they tell them, you know we don't have so much money. And then the officials just say, okay, so close down the trading place, offer the place of this company on the market, it's now for sale, and the company shut down. So this is a margin call. You know, if you have an open position with an exchange, you are forced to pay additional money in a safety account to be able to continue to trade on this exchange. Okay. And this is clearing, settlement, margin requirements. Okay. This is an extract from the Wall Street Journal, and you can see it's US to take over AIG in 85 billion bailout, central banks inject cash as credit rise up, and later on they say, for one thing, banks and mutual funds are major holders of AIG's debt and could take a hit if the insurer were to default. In addition, AIG was a major seller of credit default swaps, essentially insurance against default on assets tied to corporate debt and mortgage securities. Weakness at AIG could force financial institutions in the US, Europe, and Asia that bought these swaps to take write-downs or losses. AIG millions of insurance policyholders appear to be considerably less at risk. This is why AIG is usually a very good but also a very bad example of an insurance company that was systemically relevant. It is a good example because it can happen. It's a bad example because it didn't happen because of the insurance business. It happened because AIG was active in non-insurance business, and non-traditional insurance business. Okay, so this is credit risk. On the next couple of slides, you can see some extracts from the annual reports of large German banks. This is the DZ Bank Group. This is the head institute of all cooperative banks in Germany. And you can see that, for example, they have a credit volume of 314 billion euros in 2011. They decreased this a little bit in 2012. And you can see, for example, they have given out loans mostly to the financial sector, to the public sector, to corporates, to retail customers, and other banks. This is very special because this is a very special bank. It's the head institute of the cooperative banks, and the cooperative banks that are associated with the DZ Bank, these are the ones giving out the retail loans, and this head institute is mostly active in corporate banking. And this is, I guess, all the time I have left. Do you have any questions? So if you have no questions, thank you for your attention, and then see you next week. Thank you.